All right, welcome to position review for December 14th, 2016. I have listed here my overall positions on my account. You can see my delta, thetas, etc. I won't dwell on this. Made a little bit of money today, so that's always a good thing. Go to the Analyze tab as usual. This is the January butterfly that I detailed yesterday in a little bit from beginning to end, and didn't have to do anything to it today. So it was down about 5,500 yesterday, so we've made back a little bit today, and there's really nothing to do. The plan is just to allow it to sit inside this structure. If we can oscillate down a little bit or just hover around in a sideways range, that'll be wonderful. We can make some money back. If not, if we get continued upside movement, I will roll these 4850s out probably one more time, maybe another butterfly roll with the two remaining calls here. Try to widen it out a little bit and squeeze a couple of $1,000 back out of this. Otherwise, I'll just close it out and take a loss if we continue to rally. If it moves down really sharply, then I will have to move these puts down, similar to the way I took the initial calls and rolled them up. I'll take the short put, roll it down a little bit, which will bring up, you can think of it in several different ways, but we'll think of it, we'll bring this leg up and reduce our downside risk if we start sliding down the backside of this slope if there's a large sell-off. So that is January on NDX. I haven't modeled out February, so I'll just do this to show you the actual positions. And we're basically delta neutral. This is, if you've ever heard delta neutral trading, you weren't sure what it was. If our delta value here was 0, we would be absolutely completely neutral. So I mean, so 5 to 111, and I won't go down this rabbit hole, but the delta it measures the dollar amount we're going to make for a $1 move in the underlying. And so a $1 move in the underlying can be a very different thing. So NASDAQ, the NDX, is almost a $5,000 stock. If you want to think of it as a stock, it's not a stock, it's an index. You can't actually trade this, but that's almost $5,000. Imagine a $49 stock that you're trading. It's 1/100th the size, so your delta value is going to be much different there. So a $1 move on a $50 stock is quite a bit different percentage than a $1 move on a $5,000 stock. So if you want to do this little ratio that I like to use, this delta to theta ratio, you have to understand that you can't use one ratio for every underlying product that you're trading, because the value of the delta depends on the price of that underlying. So all that aside, essentially, another way to think of it is being delta neutral is right on the top of this curve, which is where we're sitting, which is a decent spot to be in. So we have a decent amount of room to the upside. We've got some room here to the downside, and so the theory of this trading strategy is just to let the probabilities play out. It should stay in the middle of a bell curve. We'll have some coin flipped head and rally a few days. We'll flip some tails and sell off a few days. And net, it just kind of stay inside of a range. And when the market's in a mean reverting, range bound regime or scenario, this works really well. When we in a momentum trending regime, this does not work so well, which is currently the regime we're in. Which is why, and so I have this leaning a little bit to the upside. I feel like I've got a little bit extra room up here. So as with the butterfly, if we continue to rally, I might defend this 51.75 call one more time. I might roll it out and see if I can squeeze out just a little extra credit if the market actually slows down. But otherwise, I'll probably just take this off. And as I take that off, I'm going to expose myself to a large downside move. So I'll close out some of these puts as well. And I haven't, actually, let's just take a look real quick. So if I go into my position statements and I look at these February puts, so this structure is, so I sold these two puts for $33.64. They're down to about $12.80 now. I bought 3 extra puts for insurance. Of course, they have lost value as well. So we're not to the point where we can close this down yet. And then this 44.45, 44.25 is just a straight vertical. That's what I did 5 times. And obviously, there's quite a bit of ways to go before I'll close that. Speaking of closing, I will take about half of these off, probably 2, if we get to the point that we're 50% of the credit I sold these for. And so I sold these for about $2.50 approximately. So we get down to $1.25 on this spread. I'll close half of these, and then I'll hold on to the rest and try to get them for 25%, buying them in for 25% of what I sold them for. So that's one way I manage these positions. Moving on to Russell. Again, this is not an accurate P&L. The one on NASDAQ is accurate P&L. The one that where I put all the simulated trades to indicate the actual trades with the actual prices where I was filled. So this does actually calculate the correct accurate P&L. If I just look at my positions and look at January and then hide the simulated trades, you'll see that, oh, I'm sorry, that's February. We unmarked the simulated trades. So the position is identical. The Greeks are identical, but it's telling me I have a profit of $13,000, and we know that my actual profit is much, much less than that. So I can look at this structure this way and manage it this way, just looking at my delta, theta, and vega, and just ignore the P&L number because I know it's not accurate. So, and sometimes I do it this way just because it's easier. You don't have to mess with keeping up with all these little simulated trades, and make sure you have clicked them correctly and have them all saved and stored up. So sometimes I'll just look at this and know that my P&L is wrong, and if I want to actually keep track of my P&L, I will take all these transactions, export them into an Excel spreadsheet, and then I will look at my positions there. And I will show that spreadsheet on another occasion because it's fairly complicated. So back to Russell. If I only have January on, it's the only thing I have on. And again, this is not accurate P&L. I've been beaten up on this position because I started when Russell was down here, and I've had to roll and roll and roll and sell more puts and close calls and roll calls. So this one's been a struggle. But Russell has backed off a little bit from its high. I think I can't remember exactly where it was. Let's go look at a chart. It was up here almost to 1400. So that high on that day was 1392.71. So almost to 1400. So we were pretty, pushing my short strike up here pretty high. And so we backed off down to the center of this range. So that is very nice for me. Same management technique, same style. Just hope it stays somewhere in the middle of this range. And as days go by, the purple line will rise. As volatility comes out of the market, this purple line will rise. And just let time decay do its thing and make a few more $1,000 and get out of this thing and cut down some of the loss. I doubt I'll be able to get this one back all the way to profitability. It's down, I'd have to go look at my spreadsheet. I think it's down about 3,000, 3,500, somewhere around there. Let's look at SPX finally. So we'll look at January to start off. It looks obviously very similar to Russell. Same scenario. SPX rallied pretty strongly, so I've had to sell some extra puts. I've had to move some calls out of the way. Right now we're right around the middle of this graph, so same story. Just give us some time, let let theta do its thing, let time decay do its thing. We're selling decaying assets, so every day that passes without a large move is good for us. Well, speaking of large move, as an aside, it's very interesting that on Monday I was planning, or anticipating anyway, that there would be a large move on Wednesday during the FOMC announcement. And we had quite a large move on Tuesday. I didn't even bother to look at the news. I don't know, there was some reason, I'm sure, given. But there was a really large move, bullish move, rally, especially on the NDX on Tuesday. And then today's action on Wednesday, there was some volatility spikes up and down, but net, not a huge big day. So that just goes to show, when a news event is coming out, you anticipate or you would expect that the news event would precipitate the large move, and really it wasn't that big. Whereas the day before, you got quite a rally, just out of seemingly nowhere. So I am more and more convinced that, generally speaking, for the most part, not 100%, but pretty close, stock market movements are pretty random, which is why I adopt a neutral-ish option selling strategy, because I'm the casino. And if I'm playing a random game of chance and my odds of winning are at 47 or 48% chance, I can't win that game in the long run. So if I go to a roulette table and decide I'm going to put my money on white or black or choose a number, I'm going to lose over the long run, unless I might get a lucky streak. But there's no edge there. There is an edge if you're the casino. So I'm being the casino. I'm just letting the probabilities play out in my favor, and the only thing I have to worry about are big outsize moves in one direction or the other. We'll move on to February. Now February, I am playing around with a new-ish strategy. I've done this before, but I haven't done it in a while, so I'm experimenting with it again. And I will detail, I added some more in March, as you can see down here. I will detail those in a new video, detailing these new positions. And so February, I have no call side whatsoever. I have no short deltas in this position whatsoever. This is 100% a bullish position, a put selling position. However, because we've been rallying and potentially could be near the top of a market, or at least due for a decent sized pullback, I didn't just want to sell puts naked, and I wasn't even that thrilled with selling them as verticals. So I'm experimenting with a ratio strategy as well as the verticals. And so if I make this a little bit longer, wider, you can see that if we get a sell-off, I have this extra protection, which is why my graph swoops up to the downside. And so the management here is, if the market rallies, do absolutely nothing until it gets up to a point where I want to close it for my profit target. If we stay here, let time pass and do absolutely nothing. If it moves down slightly or slowly, do nothing. Just let it sit and let time decay. If it starts to move more quickly and things become a little more scary, well, then I'll take some defensive action. Now, those defensive actions could be just selling a call. It could be selling a call vertical. I could buy a put vertical here at the money. I could buy a put vertical down here a little ways. I could just close one of these short puts and take a loss on one of those out of the several that I've sold, just to defend this position in case it continues down further. So there are many adjustment things I could do. I could even throw a new position on top of this. I could add another iron condor. I could throw a butterfly in here. There are many things you can do which become more complicated. But to keep things simple, the first thing I would do is probably sell a call and just see how that goes. Although the downside to that strategy is if we have V bottoms, and if we go look at a chart, there's Russell. Let's go look at the SPX. If we go look at the SPX this year, we've had quite a few V bottoms, V bottom, V bottom, V bottom reversals. So V reversals are no good for me because as we move down, things start to look scary. So you say, oh my gosh, let's go sell a call, and then you get the whippy, fast, upside rally reversal, and this call you sell for $5, $10 or so can become $30, $50, $100 if you don't take care of it. So that call can really blow up in your face, and you can lose so much on that call that even whatever you're making on this entire put structure doesn't make up. These gains don't make up for the loss of this call if you get a really strong rally and you've sold the call at what turns out to be a bad location. In hindsight, you don't know it at the time. So that is the management technique there. Those are the way the positions currently look. I do have something on gold and bonds, but I won't show those today. Detail those. Probably I'll wait till I start a new series of trades, because right now it's all these just jumping in. It's a bit inexplicable. So as I make new positions, things will become more clear. You can see them develop from the beginning. And so we will stop there for today. Thank you very much for watching.